Welcome to the channel. Today our subject of discussion is PIA privatization and risk economics, or what we can say is risk analysis. As far as PIA privatization is concerned, the first question which comes to our mind is who bears the real risk? That is taxpayer versus investor. In this case, first let us separate past risk from future risk. This distinction is critical and often misunderstood. Now, first type of risk is legacy debt, the debt which is already anchored, that is historical and sunk cost. This shall be ultimately paid by taxpayer. Likewise, past losses which have which are already incurred, these shall also be paid by the taxpayer. Pension areas which are accrued, these are also to be paid by taxpayer. Government guarantees owed, which are contractual in nature, these are the expenses are also to be borne by the taxpayer. Of course, the future operating losses, which are prospective, not yet occurred, these will be these will be borne by the investor. Key rules of corporate financing: you cannot transfer sunk cost to buyer. Markets do not pay for the cost. Number six, risk is fuel and foreign exchange volatility. This is a prospective risk in nature and it shall be borne by the investor. Fleet renewal, that is capital expenditure related to the expansion of PIA. These are prospective in nature and shall be borne by the investor. Then, labor restructuring costs. It is also a prospective in nature and investor shall be responsible for this. If there is any bankruptcy risk, it is a prospective risk and shall be borne by the investor. Now, let's quantify the risk transfers. The amount is in billions of Pakistan rupees. Number one, legacy debt, which has already occurred, that is shifted to the government to the tune of about 600 to 650 billion rupees, that is to be ultimately paid by taxpayer. Annual loss avoided 40 to 50 years, this is saved. Equity paid by the investor about 135 billion rupees. This shall be paid by investor. And future capital expenses commitment, at the moment about 80 billion Pakistan rupees. The upcoming investor will be investing in this sector. The operational downside is, say, about 10 years. This is unlimited and unloaned. This will be bought by the investor. Our interpretation is taxpayer absorb finite known losses and investor accepts open-ended future risk. Coming to the time dimension of risk, time horizon and dominant risk bearer. The past is the taxpayer shall be responsible. Short term, 1 to 2 years. Mixed, that is responsibility of taxpayer and investor, medium 3 to 7 years investors, and long term that is 8 plus years shall be the responsibility of investor. Now, this PIA fails again. Government is not obliged to bail it out. Airline can shrink, restructure, or exit. That is the single biggest transfer of risk. Our conclusion is taxpayer for the yesterday's mistakes, investor pay for tomorrow's uncertainty. This is structurally correct risk allocation in privatization economics. Now, impact on the public because liability stay with the government. Frankly, this is the most emotionally charged issue and the most misunderstood. Would these liabilities exist without privatization? Answer is yes, 100%. There are two scenarios. If we keep PIA as public, government pays legacy debt and government also pays future losses every year. If PIA is privatized, government pays legacy debt, but future losses are borne by the investor. Therefore, the conclusion is privatization does not create the liability, it stops from growing further. Now, while we continue to discuss impact on the public because liability stay with the government. B. Fiscal comparison 10-year view. The first scenario is PIA remains state owned. In that case, it would occur annual loss of 40 to 50 billion. 10-year cost 400 to 500 billion plus interest on the existing debt. The second scenario is PIA privatized, that is resulting in one-time crystallization of debt, no recurring operational bailouts. Net public saving, hundreds of billions over a decade. Let's come to the impact on ordinary citizens, that is the real effect, area and the effect. Number one, taxes, neutral to positive. Number two, subsidies, less crowding out. Number three, IMF conditionality, it is easier compliance. Budget predictability, that shall be improved. Inflation pressure reduced, at least at the moment. The biggest public benefit is what government can now spend money on instead health, education, and infrastructure. Why this still feels unfair to the public? That is the question. Because losses are visible and immediate, benefits are indirect and delayed. Privatization exposes past mismanagement. Frankly, economically sound decisions often feel politically painful. Now, what would have been the worst alternative and the outcome? Salvage debt, you will find no buyers. Wait for better price, you will incur more losses. Keep restructuring Internally, maybe more political interference as usual, liquidate PIA, massive, resulting in massive social and economic shock. The conclusion is the public is not paying for privatization. It is paying for decades of prior misgovernance. Privatization caps the damage, prevents recurrence, and creates fiscal certainty. Final synthesis, question, and a possible answer. Number one, who bear historical pain? Of course, taxpayer. Who bear future risk? Investor. Does public loss bore after privatization? Certainly no. Does the public stop future losses? Of course, yes. Is this fiscal is this decision fiscally rational? Yes. Now coming to passenger fares and regulatory safeguards. It is number one, stress test, passenger fare post privatization. Key number one. Number A, key assumption. Parameter, value, oblique assumptions, and rational. Privatized airline. 75% private ownership. Arif Habib led consortium. That is the actual deal. Cost base, fuel plus labor plus maintenance. That is about 70% of the revenue historical PIA debt. Revenue growth about 5 to 10% annual. This is conservative, aligned with passenger demand. Profit target 8 to 10% EBITDA margin, typically for low to mid cost carriers in South Asia. Competition, domestic and regional carriers remain, that is, Air Blue, Sarins, Emirates, etc., and code sharing airline. That is realistic assumption. Here impact scenarios. The chart indicates the columns are scenario, action by airline, likely fare effect, and notes. Scenario 1, conservative pricing, maintain market share, moderate yield increase. The likely fare impact could be about 5 to 7% increase to offset operational efficiency and cap acts. Scenario 2, aggressive turnaround. Focus on profitability, optimize routes, reduce loss-making flights. The fare increase could be 8 to 12% on marginal routes. Non-core or loss-making domestic routes may see selective increase. Scenario 3, monopoly routing, monopoly pricing. Where there is a high demand, particularly on the international route, likely fare effect 10 to 15% increase. Slots for European Union, Middle Eastern routes may allow pricing power. Scenario 4, foreign exchange shock stress test. Action by airline 20% price rise, Afghan rupees depreciate. Then there could be a fair increase of 15 to 20%. Airline may pass bulk of cost to passengers. Scenario 5, full competition, new impact on core share deals. Likely fair effect would be 0 to 5%. Share constraint due to observation. Passengers on domestic trunk routes may see small to moderate fare increases, that is, ranging from 5 to 10% in early years. And in case of international premium and monopoly routes, may experience larger fare adjustments, could be about 10 to 15%. If fuel price spike or Pakistan rupee weakens, fare could rise by 15 to 20% temporarily. Operational efficiency and fleet modernization can partially offset fare increases. Coming to the regulatory safeguard to protect passenger interests, the existing regulatory framework is as follows. Authority and a role. Pakistan Civil Aviation Authority, that is PCAA, its role is regulate safety, licensing, rules allocation, and consumer protection. The second regulatory authority is Competition Commission of Pakistan, that is CCP. It prevents anti-competitive pricing and abuse of monopoly positions. Number three, consumer protection laws, rights regarding refunds, delayed, and lost package. Now, passenger safeguards post-privatization. How passengers, what are the regulatory measures and the strengths or enforcement of these regulations. The first case is fare spikes on monopoly routes. CCP can investigate abuse of dominance. The enforcement is medium, enforcement historically slow. That is the history. Flight cancellation, service reduction. PCCA required route obligation for certain domestic routes. The strength is high, can enforce penalties. Safety maintenance shortcuts. The regulatory authorities are PCAA audits and ICAO standards. I mandatory certification. Coming to the passenger rights regarding refunds, delays, and loss of baggage, etc. The rules are Civil Aviation Rules 2016, updated in 2023. The enforcement has been medium to high, and these are, of course, enforceable. Port share monopoly abuse. Government may impose route sharing requirements or limit slot exclusivity. The strength is medium. Now, what are the some important recommendations for important or effective passenger protection? Number one, fare monitoring. That is, CCP should monitor route level fare for sudden increases post privatization. Route obligations maintain minimum domestic connectivity on essential routes for the public interest. Transparency publish annual airline performance OTP that is on times number of flights divided by total number of flights multiplied by 100. And if OTP is 90% plus, it can be rated as excellent. If it is 80 to 90%, it can be classified as good. If it is below 70%, delays are normally becoming frequent, and therefore this performance is not so impressive. And the other data regarding flight cancellation and safety statistics. We continue to discuss recommendations for effective passenger protection. Number 4, Consumer Complaints Portal. Streamline digital complaint resolution system. Number 5, Competition safeguards. Encourage new entrants or code share agreements to prevent monopolistic abuse. Number 6, Contingency measures. PCAA can mandatory temporary fare caps during fuel and foreign exchange shocks on essential routes. These are the different ways herein that are ways to protect passenger interests. And now coming to the expected outcome, this table passenger group and likely impact. The domestic travelers, moderate there could be likely moderate fare increase and but more reliable service. It is expected. International travels, potentially high fares on high demand routes with improved safety. Jet travelers, minimum loss if competition exists. Fare sensitive routes remain competitive. General public benefits indirectly from a fiscally healthier airline, less subsidy burden. Summary, fare like to rise modestly from 5 to 10% on domestic routes, more on monopoly or international routes. Test testing shows maximum 15 to 20% under extreme fuel cost and foreign exchange shocks. Regulatory protection, current framework exists. There is CCAA, CCP, and consumer protection laws. But active monitoring and enforcement will be critical post privatization. Passenger outcome. In most scenarios, passenger experience better service reliability and safety with moderate fare increases justified by efficiency gain and fleet modernization. With this, we conclude our discussion on today's subject, that is PIA privatization and risk economics or risk analysis. If you have not yet subscribed this channel, please do so. Please share, subscribe as soon as possible. Thank you and thank you very much.